Thank you, Irene. Good morning, everyone. Thank you again for having me here. I thank you for your participation and welcome to today's webinar, Business Loan Application Forms and Package Explained. Like Irene said, I'm a commercial loan advisor, Edgar Darrell, with Genwest Capital, and I'm excited to guide you through the key documents and steps that can make or break your loan application. Here's what we'll be covering today: the standard loan application forms, what's included in the personal financial statement, and the supporting documents that are needed to prepare. And at the end, if you have any questions, we can take some Q&As. But before we dive into this webinar, I'd like to take a moment to explain and understand why this topic is so important. Applying a business loan can be a critical turning point for your business. Whether you're launching a new venture or expanding your operations or navigating a financial challenge, many applications are denied not because the business is unqualified, but because the application package is incomplete or poorly prepared. Lenders are they're not just looking at your numbers. They are evaluating how well you present your business and your personal financial position. Every form, every statement, every document you submit tells a story. A clear, accurate, and well-organized loan package demonstrate professionalism, preparedness, and credit worthiness. Let me give you an example. This was a while back. I was assisting a small manufacturing company that had a solid business model and strong revenues, but their loan application was initially rejected. Why? Well, they submitted an outdated financials, omitted key liabilities from their personal financial statement, and they didn't include documentation for business licenses and applications. So at the end of the day, regardless of what they see as far as their financials, the lenders decline it. Well, after sitting down with them and fixing those issues, we resubmitted a package with the updated, completed application and documentation, and voila, the loan was approved within 3 weeks. That loan, by the way, helped them acquire equipment. They were able to hire 2 employees and grow their production capacity by 30% in under a year. So, understanding how to properly complete and submit your loan forms is not just about paperwork. It's about putting your business the best possible position to succeed. So, first up is the standard loan application overview, primary documents that are used by a lender. So in this case, your first impression accuracy is the key. What are the key sections of a standard loan application? This form basically will ask for basic information about the business, the amount and purpose of the loan, ownership and management details, and a summary of your business financials. Also expect some yes or no questions about legal or credit history. Let's take an example of an actual business loan application. Let's use, since PACE is our host, let's use their business loan application. I'm not sure if this is the most current one, but this is the one I have on file. So as you can see on section 1, it asks for business information. So They'll be asking for your legal business name, your mailing address, business phone information. Typically, if you don't have a fax, that's okay. You can leave it, don't leave it blank, just put NA or none. Cell phone number is important. Why is it important? Because if someone gets a hold of you right away, they want to get a hold of you. This is the method of communication nowadays. In the old days, they would have to call your landline. Nowadays, they just have to reach for your cell phone. You can either reply back or answer back right away. Uh, the franchise name, if you have a franchise, you can list it there. If you have a different business location other than your corporate mailing address, please do so. Some businesses have their mailing address separate than the actual business location. Date the company founded, your federal EIN number, date of current ownership, and then the NAICS code. That can be located in your tax returns, or if you don't, you can just Google it, NAICS code, and type in the type of business you have, and it will provide you with the number. Then the next line is the organization, whether you're a C Corp, S Corp, LLC, or a sole proprietor. Then it will ask for your average monthly sales, your average annual sales. Why is this important? Because it tells the underwriter or processor, the type of volume you have. Initially, this is, like I said, this is a snapshot of your application form. So first impression, just like, you're introducing, somebody's introducing you to a very important person, first impression is key as well. Then the second, section 2 includes your principal information, who are the management or executive officers of the corporation or entity. How much of ownership do you have? Typically, as most lenders, they will require that anybody who owns 20% of the business is required to guarantee the loan. So all of those principles must be listed under Section 2. Section 3 details for loan amount information, the amount of loan requested, terms requested. So when you talk to a PACE loan officer or loan counselor, they will ask you how much you need. So it's based on the actual purpose of the loan. So just write down the amount and then your preferred term requested. I believe with PACE, they can go up to 5 years, typically 3 years, but 5 years, I believe they can. In most commercial banks, they can go up to 5-7 years. With SBA, it's 10 years or 120 months. It is also asking for if you can check the purpose, you can check the inventory, equipment, or working capital. Now, the next slide will show you the business and purpose uses. This next section on this is your business and personal reference. It tells you, usually you can put your insurance agent's name or your CPA for this one. And then if you have any other additional guarantors other than the principal owners, then you must list it on Section 5. And then, of course, the obligatory John Hancock at the very bottom. The next form is Section 6 of PACE's loan application form. It's the purpose of the loan. So this is important, especially with how you want your loan to be allocated. So this is an allocation of your loan requested amount. So you can put in on project items. Below that, you can say marketing, item cost, $10,000. Equipment purchase, and then you can put in the actual amount that you're requesting. And then down below, right below number 12, under project item, it's asking for working capital or other, and it says describe. So the more detail you put in there, the better your chance. So you want to be able to convey, what the purpose of the loan. So if your sole purpose is just working capital, you can totally avoid numbers 1 through 12 and just list the explanation on why you need working capital. And then, of course, source of injection. So what that means is that how much of your own money would you be putting in? As previously described in our previous webinar, under the 5 C's of credit, you must have some skin in the game. Remember that? So you put in your source of injection. Usually it's about 10% of the total project cost. So if your loan amount is 100,000, you put in 10,000, and where is that money coming from? Usually you put in there business savings account or business checking account. And of course, the total loan amount request will be your total loan request minus your injection or equity injection. Now, for working capital, they usually don't ask for injection because you have an established business. But for startup businesses, putting your source of injection and how much is very important when you fill out this application form. The next section for this application is the collateral worksheet. Remember, again, in our previous webinar, I think it was a couple of weeks ago or last week, we highlighted the importance of the 5 C's, and one of them is collateral. So this is the form where you will say, this is how much I can offer into the loan. This is what I'm willing to pledge in order for me to get the loan. So typically, it's broken down into inventory, machinery, equipment, furnitures, fixtures, commercial real estate, and then if you're willing to put in your residence, you have to put in there. If you own other real estate property, you have to list it there. If you look at the column 1, 2, 3, fourth column where it says typical discounted rate. So what it means is that if you have inventory worth 100,000, they would only consider 35% of that 100,000, not 100%. So that's the discounted collateral value. So you add it up. So if you have furnitures, they can only consider 10% of that equity. And commercial real estate, building and land, for this purpose with PACE, they would consider 50%. Some other institution may consider a higher discounted rate, maybe up to 75%. But in this particular form, they would only want 50% of the discounted rate. Now, as far as your residential equity or your equity in your home, they would consider 80% of that. So how is that computed? You take the value of your property multiplied by 80% minus your current loan balance, and that will be your residential equity. So that's the amount of equity that you have in your property. That's called lendable equity. That's not your true equity. Your true equity is just whatever your loan balance minus subtracted from the value of the property. But for lending purpose, your lendable equity is up to 80% in PACE's case. Rental real estate as well is 80%. If you own a fully paid automobiles or vehicles or trucks, they would consider 65% of that. Now, the next sheet of application would be the monthly personal expenses worksheet. This is a worksheet that PACE requires on each of their loan application. In certain cases, in some banks, they don't have this worksheet per se, but you have to list it in a separate form. But PACE use a standard form to make it easier and streamlined. So this will determine how much you make a month or a year, and compare that with your monthly expenses. So at the very top, right below the section 8, it says monthly income. So paychecks, if you have paychecks from outside source, or if you're paying yourself from W-2s from your own company, you have to list it there. Other income includes rental income, if you own real estate property, investment income, or if you own stocks or bonds. Then below that, you will have all your housing and personal expenses. You have the housing expense, your rent, your utilities, insurance, telephone, home maintenance, transportation, how much you spend on your transportation, insurance, food, medical, education, childcare, all your other debts, including credit cards, medical bills, or personal loans. And you total all of that and subtract that from your net income, and it will give the underwriter your net cash flow. This cash flow, this amount will be transferred into their debt calculation worksheet to determine your ability to repay. Now, let's look at the personal financial statement form. I'll be sharing a sample of that as well in the next slide. So lenders wants to know about the personal financial health of owners. That's where the personal financial statement comes in. Every 20%, like I said earlier, everyone with 20% or more ownership will need to complete one. This form includes assets like cash and property, and liabilities like credit card debts and mortgages. The goal is to determine your net worth and whether you can personally guarantee the loan. Now, what are the common mistakes to avoid on your personal financial statement? Be careful not to overvalue your assets or forget to list your liabilities. If your numbers don't match your tax returns or bank statement, it raises red flag. So when I say don't match, I don't mean, $1 short or a couple $100 short. What I mean is, if your tax return shows, $10,000 and you list $1,000, that's a big red flag. But if it's just a matter of rounding up numbers, you don't have to worry about it. Okay. Let's see here. Now let's look at an actual personal financial statement. Again, we're using PACE's loan application, or personal financial statement rather. As you can see, most of the personal financial statement are the same, format. It's just a different information sometimes, but they capture in essence what I talked about earlier, which is your statement of your personal assets and your personal liabilities. So on this form, you have the assets on the left-hand side, and then the liabilities on the right-hand side. So first step with the assets would be cash on hand in banks. What it means is whatever cash you have in your checking account. Not business though. If you're a sole proprietorship, I guess you can put your business account there. However, they're talking about your personal assets. So when you put in your personal assets, don't include your business balances there or anything regarding businesses. This is solely for your personal assets and liabilities. So cash in banks, savings accounts. If you have a retirement account, this is mostly if you have established IRA or 401k, you have to list it there. Accounts and notes receivables. A lot of people are asking, what are those? Well, those are receivables that are due to you, meaning you're about to receive it, whether it personal or a company owes you personally, then you have to list something there. Inventory means if sometimes if you're, especially this works if you're a sole proprietor of your business, so you own it personally. So if you have inventories, you can put it there. Prepaid expenses can be considered an asset. You can ask, if you have prepaid insurance or some other stuff that you have prepaid, you can list it there. Sometimes you just put zero to it. Now, life insurance, cash surrender value only. A lot of mistakes are being made when you fill out this particular section here, because some business owners tend to put the actual face value of your insurance, whereas they're only asking for the cash surrender value. If you have a term life insurance, you wouldn't have any cash surrender value. But if you have a different type of insurance, then you earn some cash to it. So you have to list that particular value. All right. So term life doesn't have cash value. Other types of insurance may, and that's where you put in there. Then stocks or bonds. Real estate, this is some people will put in their monthly payments under the real estate section. That's not the case. What it means is you have to put in your actual value of the property. So if you go on Zillow and type in your address or Redfin, that's the value you put in there, the Zillow estimate or Zestimate as they call it. So if you have $1 million in Zestimate from Zillow, you put $1 million under real estate. And then other personal property and other assets, this could be jewelries or artworks that you hold, valuable artworks, anything that has value, you can put it there. Automobiles as well. In some personal financial statement forms, there's a different section for automobiles, but in Pace's case, you just have to put in your personal automobiles in this particular section. And what I mean by assets with autos, what I mean is your blue book value, not the actual purchase amount. As you know, when you purchase a new vehicle, that value depreciates, I think by 35% or something, when you drive out of the car lot or the dealership. So if you buy it for $100,000, you don't put $100,000 in this particular section. You put, $65,000 because that's the depreciated value of your car or your truck. And then you just total your assets. You just slide over to the liabilities, your accounts payables, your notes payables. Notes payables and accounts payables are, kind of confusing because sometimes you don't have any accounts payables, and some people put accounts payables under notes payables. They're okay, as long as you're listing all your monthly payables or your yearly payables there, that's fine. But in essence, notes payables are bank notes that you pay other than the installment account that you have. So this could be some personal notes or a personal loan that you have, or let's say, you have a furniture account, then you can put, that account over there as well. Credit card debts, you can list it there either under the notes payable or accounts payable. Installment account for auto, like I said, if you're financing or you finance your car loan, then you put the balance on the loan, not the monthly payment. Some borrowers put in their monthly amount. please don't put your actual loan balance or estimated balance. You don't have to be downright specific as to the balance. So let's say your balance is $39,000, 999.72. You can just put $39,000 there. Okay. Uh, some business owners have loan on their life insurance. So you put in your loan balance there as well. Now, under the mortgage on real estate section, this is where you put in your combined first and second. If you have a second or a home equity loan, you put in your total balance over there. So if you have 100,000 or $150,000 home equity loan, you add it to your existing first mortgage, let's say for 500,000. So your total mortgage on real estate is 650,000. This is where you put in there. Unpaid taxes, if you are making payments or installment payments to the IRS or the franchise tax board, that's where you put that in. Other liabilities, anything that is not covered from any of the above sections, you can do so. And then you just add all your total liabilities, subtract that from your total assets, and that will give you your total net worth. So it's total assets minus total liabilities is your personal financial net worth. So the higher your financial net worth, the better it is, because it means that you have the resources, the liquidity, the assets to support, a loan request. Then if you add the liabilities plus net worth should total net worth and liabilities. So a little bit of tip, if your total asset doesn't equal to your total net worth and liabilities, there should be there's a mistake there. So you have to make an adjustment. Always, all the time, the total assets must equal the total net worth and liabilities portion. All right. So again, total assets should always equal to the total net worth and liabilities. If there's any discrepancy, then you have to adjust and look it back. They have to equal all the time. Section 1 of the personal financial statement, or PFS, as we normally call it. Source of income, your salary. You can put in your monthly salary or your annual salary. Net investment income, real estate income, or if you have any other income, you can describe it below. And you can list it and describe what it is. Now, contingent liability. So what that means is if you have co-signed for a relative or a friend, or you have some other liabilities that are not directly attributed to you, then you can put in there the amount of your contingent liabilities. Legal claims and judgment must also be put in there. What that means is, let's say you got sued and there's a judgment against you, or there's some legal claims, then you have to put that amount under contingent liability. Then if you have some federal income tax that's are coming due, then you have to put it there as well. The next section is just an explanation from the first page. So you just have to itemize in details what are those note payables. Now, if you have several credit cards, right, you don't have to list each and every one of them, although it's recommended. But if there's too many, you can just put several credit cards or see credit card debts, and then just the balance and your monthly payment. But don't put, I see a lot of borrowers put in see credit report. And a little bit of a tip, the underwriter doesn't like that, because it takes away their time, to put in your package. That means that if they don't have your credit report, they have to pull your credit report and look at your individual file and see what you have under notes payable. And so that's time consuming. That takes away the time to process your actual loan. So it helps if you put in an itemized list of your credit cards. But if you have, maybe two or three, you can just list them over here. Or, like I said, preferably you can provide an additional sheet of paper to list all your credit card or personal bank debts. Stocks or bonds, just whatever. If you own Apple, uh, Tesla, I hope not, but Apple or GM or Ford, you can just list it over there. Now, section 4 is your real estate owned. So if you have your the proper sequence should be, your primary residence should be in your property A. Property B should be your rental or your second home, and property C should be your other real estate properties. So it just lists, they want to know what type of a property that is, your address, date it was purchased, original cost, current market value. Like I said, especially for residential properties, you can just Google it and go to Zillow or Redfin or Realtor.com, and they'll provide you with an estimated value. Then your mortgage balance, name and address of your mortgage holder, just list that, mortgage account number. If you don't have it, you can just put, NA or not available. Mortgage balance, amount of payment per month or per year, and then your status of mortgage, whether your loans are current or not. Then the next section is just a description of what other personal property and other assets are. Like, for instance, the one that we talked about earlier. If you own a car, what the value is. If you own some jewelries or some other artworks, some valuable artworks, then you can list there. Unpaid taxes, just describe what it is. You don't have to explain. You can just put IRS, payment plan, the amount, and the balance. Other liabilities, anything other than what you listed on the other sections. Then life insurance held, just the insurance company, what type, whether it's term life or cash value, then who it is, and the surrender and the face amount, okay? And then, of course, the obligatory John Hancock right there. Now, the next one, after the loan application, after the personal financial application, you also need documents to back up what you shared. So let's go ahead and, do the next slide for what's required in most. Now, these type of documents are always required by banks, CDFIs like PAYS, and some other financial institutions. With Remember, I think the first webinar that we had 4 weeks ago, we had some alternative financing. MCAs or short-term loans doesn't really require these documents. Those are streamlined documents. Bridge loans or bridge lenders don't require this. This is what I'm talking about here are business financial documents that are required for a typical business or commercial loan. So you have tax returns, usually 2 to 3 years. In PACE's case, they require 2 years of tax returns, both business and personal. P&L statements, P&L profit and loss statements, balance sheets, and business debt schedule. So the profit and loss statements you should provide. So right now, for instance, we're going on May 1st. So in addition to the 2024 tax returns, or in case where you have filed for an extension, they will ask that you provide P&L statements and balance sheet for tax year 2024. In addition to that, because it's more than 90 days or 120 days within 2025, they will ask that you provide year-to-date 2025 numbers as well, in addition to those tax returns and balance sheets as well. Now, business debt schedule list all your business debt. So let me clarify that. Because some people, they would include their business or personal credit cards rather in the business schedule. So if you are using, and this is important for you to hear as well, this because it comes in two ways as well, when how the underwriter looks at that and how you put that into the form itself. So if you put your personal credit card balances under your business debt schedule, the underwriter will take that into your business debts, your overall business debts. So you have a business debt with all your personal credit cards, right? And then they will look at your personal liabilities. So that personal liabilities includes your personal credit card that is on the business debt schedule. So what that means is, from the underwriter's point of view, you have you have the business and personal combined, which is not true, right? So either you put in your personal credit cards under the personal financial statement, and then leave the business debt schedule to the true business debts that you have, whether because there are some business credit cards that are issued to companies, right? So if you're putting it there, that's fine. However, if you have your Citibank or your Capital One account put in your business debt schedule, please remove that, because the underwriter will double dip that when they calculate the uh, debt service coverage. So it wouldn't help your cause at the end of the day. So please just put all your business debt schedule, regardless if that personal credit card or personal loan is being used by the business, because technically it's your personal application that was used to obtain that loan, not the business. All right. Other required for those documents, like I mentioned, tax returns, bank statements, and then debt income documentation. These are your W-2s if you have outside source of income, your 1099s if you're on a 1099 form. So that would help the underwriter put in together a very complete package. The more information you share, the better they will understand your story, because it's all about story. How you tell your story, how you need the money and why you need the money, and these are the things that supports them. And basically, it will help you along the way when you apply for a loan. In addition to those documents mentioned, don't forget items like business licenses, incorporating papers, leases, and insurance. And if you're buying some equipments or property, make sure to include your purchase agreements. I've seen deals where it got delayed because they didn't have the right insurance. So they have to get the insurance, and it takes time. Leases that are needed to be subordinated, so please make sure to provide those information in advance, not before closing, because it's definitely gonna delay your loan. So I know it's time consuming for everyone, but these are unfortunately those requirements, not just by PACE, but other financial institution. Now, if you want a streamlined application, then you can go with like MCA or any other short-term applications, short-term loans, but those are high interest loans, which I wouldn't recommend. But for a typical conventional loans, make sure to provide those additional supporting documents. Now, what are the tips to strengthen your package? So first one is organize your documents neatly and make sure everything is accurate and consistent. If there are any red flags like past losses or low credit score, please include a brief explanation. You don't have to put like a 10-page explanation, just a paragraph or two, why you had a low credit score or why you had some losses. As long as it's, makes sense, then they'll consider it. Now, business plan is very important, especially if you're a startup business, because it adds value. It tells your stories, tells who you are, So if you have a business plan, it's a must. I don't know if you've noticed, if you're applying with other banks, including Pace, they will require that you provide a business plan, especially if you're a startup business. That's the reason why they want to know who you are. They want to know your business. So those are some of the tips that strengthen your business package. In summary, wrapping this up, your loan forms and supporting documents create a full picture of your business and financial standing. The stronger and more complete your package, the better your chances of approval. Thank you again for joining me today. I'm happy to answer any questions you have now. If you want to reach out, feel free. Just take a picture of the code there, scan it, and then my contact information will be there. Again, thank you. I appreciate it. Thank you, Irene.
Thank you, Edgar. I'll see you next week with a new session of a webinar. Thank you for joining us.
Thank you.